Well, it is that time of the year when the Oxford Dictionary reveals its word of the year. If we at Young Turks were to don a similar hat and tell you what the Indian startup word of the year is, well, let me tell you, it is profit. But where is the profit? That's the question we've been asking in 2022. Over $80 billion startups without a clear path to profitability. Total funding into startups has dropped by 35% to $24.7 billion in 2022 year to date from a whopping $37 billion over the same period in 2021 as per Traction. And after the hair-raising excitement of the years past, over 18,000 employees have been laid off since the beginning of the year. Well, to be honest, the criticism cannot be restricted to cash-burning, loss-making startups. Investors are also being accused of favoring founders who chase opportunity at the cost of building a profitable business. Chasing valuation over value is passé in 2022. Having said that, India's startup story is one of disruption built for 1 billion people. And as Kunal Bell recently told me, there is no founder who doesn't want to be profitable. So while finding the profitable ones was a challenge we set for ourselves, the resilience and perseverance of founders who have pursued the coveted milestone called profit is encouraging. And today we seek to recognize just that. Hello and welcome. I'm Shireen Bhan. You're watching the special episode of Young Turks, India's longest running show on startups and entrepreneurship. With me on this year-end special are 4 founders who put their startups on the path to profitability. Bhavin Pandya, the co-founder and CEO at Games 24/7. Also with me, Srividhya Srinivasan, the co-founder of Amagi, Ananth Narayanan, founder of Mensa Brands, and Amitava Saha, the founder and CEO at XpressBees. Srividhya, gentlemen, appreciate you joining us here on the program. It's good to have you here. Bhavin, let me start by asking you, as I pointed out, 2022 has been about the path to profitability. We're seeing investors speak that language, founders speak that language, unit economics is the buzzword, and of course many are trying to pivot their way out of the current slowdown and funding winter. You've been around for a while with the company when you founded it in 2006, so you've seen a fair number of these cycles. What's different this time around, and have you positioned yourself any differently in 2022?
Thank you, Shireen, for having me on the show, for inviting me. Good evening to everyone. To be very honest with you, Shireen, like you said, we went live in 2006. We've been, we've been around for a while now, and it is, as early as 2011 that we were already profitable. And so for us, to be honest with you, what we're seeing now in the ecosystem, for us as a company, we've been chasing all the way since 2009-10. And so we think that what's really changed this time around is that, now is people, investors especially, want to see returns, and they've sustained for very long or sort of supported entrepreneurs for very long to say that we'll get growth at any cost. But acquisition growth does not necessarily mean profitability, and I think everything has come together now to say that it's time for the companies or for the startups to see real value, and for shareholders to see real value instead of just seeing valuation. And I think as they say, it's like a perfect storm now. Everything's come together where it's no longer sustainable to just keep growing at any cost.
Now, I want to understand from you and from your journey, I'm sure that there has been temptation to chase growth at any cost as well. What has been the mantra, what's been the guide, what's been the compass internally that you've used to veer away or shy away from that temptation?
A very famous saying in economics is that there is no free lunch. And what that really means is that while these large checks have been written, while there has been reckless behavior to try and grow at any cost, the fact of the matter is that eventually everyone wants to see returns. Everyone wants to see what they're going to get for all these large checks that they're writing. And in our case, that was really our mantra from day one, that, look, there is no free lunch, that if we're going to try and grow at any cost, then it's possible that the growth will not come. The growth in value or the value will never come. And so we've always resisted that. In fact, the last couple of years, we've actually spent a lot more on our fantasy business, but that's precisely because we know that the unit economics there are fantastic, and that while in the short term we can spend more, that in the long run as early as FY24, we're going to be profitable on that side of the business as well, where Rummy Circle for us has always been profitable since 2011. So we've always resisted that temptation simply because of our fundamentals.
Ananth, unlike Bhavin, of course, they've been around since 2006. You've been around in several avatars for fairly long, Ananth, but let's talk about the latest avatar that you are currently in, and that's Mensa Brands. Your journey and your path to profitability as far as Mensa Brands perhaps has been the shortest, as well as your journey to turning unicorn has perhaps been the shortest of the people here on the panel. And again, I want to ask you about the strategic choices that you made, Ananth, to ensure that there was return on investment, that there was return on capital, that there was return on equity. In terms of the way that you designed the growth strategy for Mensa Brands from the get-go, what was the driving philosophy, the rationale that today stands as validated?
Shireen, thank you for having me again. Look, I think on Mensa Brands, I think, as you have said rightly, I've been around the block, so Mensa and MedLife, which were both cash burn businesses. So I think even when I started, the philosophy was always you'd be less capital markets dependent. And so while we've raised funding and so on, we always wanted to be profitable. We're 18 months in, we're a 1,500 net revenue run rate business, and we're EBITDA profitable, not adjusted EBITDA, etc. We're just EBITDA profitable. And as someone recently told me, I think the next stage for us is to generate a bunch of free cash flow, which is what we're aiming towards over the next 12 to 18 months. The design actually is quite simple, Shireen. The first is, if you're really a brand, you should be able to grow without just subsidizing and burning. I think that's number one. Number two is I fundamentally believe that over time, if India actually has to have multiple large global brands, you have to build it right from the scratch. And I think the race is only with yourself. While I think the unicorn thing is touted quite often, I'm actually a lot prouder of the fact that we actually turned profitable in 7 months. We are really a house of brands. We're trying to build a house of brands, not just an aggregation of revenue and EBITDA. And I think that's quite interesting. Many of our brands now are starting to, the reason we're profitable is actually quite simple. 6, 7 of our breakout brands are starting to really grow rapidly and are double-digit EBITDA profitable, right? Whether it's a Dennis Lingo, whether it's a Villain, whether it's Pebble, which is a smartwatch brand, or with peanut butter. We've been able to get the product market fit right, where customers are coming back. The second is we've been quite strategic about the areas we've picked, Shireen. Fashion, beauty, and home all are 70% gross margin categories. So economically, it's possible to build a brand, invest in brand building, and still make money. And I think that's the other thing that's actually worked very well for us. And the third is even before the slowdown happened, we have been very focused on return on invested capital. And therefore, we've been quite conservative in how we have actually acquired brands and how we've actually structured it so that there is a good return on equity and return on invested capital. And we want to be, as we go IPO, we would love to sort of make sure that we're in the 20% ROIC range, right? Which is really how value gets created, and that's how you return money for investors.
Srividhya, I want to understand from you, as we heard there from both Bhavin as well as Ananth, turning profitable is not as if it's a switch that you can turn off or on at will. There are strategic choices that need to be made through the course of a company, a startup's journey. Smart business is also about learning the art of sacrifice, of not wanting to do everything or wanting to be someone for everyone. I want to understand from you, from the Amagi journey, of what have been those strategic choices that you've made, what have been those areas that you decided to give up on, even though it may have seemed like, if you could throw a little bit more money there, you would have been able to garner market share, etc. Take me through the choices that you've made to be able to get to this point.
Yeah, thank you for having me here, Shireen. So in Amagi's perspective, we started the company in 2008. Initially, we ran this company as a geo-targeted advertising company for Indian broadcasters as well as for Indian advertisers. We were doing this business till about 2014-15. By that time, we realized that it is actually somewhat cannibalizing the national broadcasters business, and therefore we are better off looking at or pivoting to an international market. So when we looked at the international market, we realized that we can build a cloud-based media logistics company. We actually reduced the cost for our customers. And because we reduced their cost, they would prefer Amagi even in a pandemic end, even during the time when the market is not doing great for them. We saved their cost. That's how we looked at it. And there are other regions where we can pivot. For example, we can do something related to content production, wherein there are it's a crowded space, there are a lot of partners. Day one, we were very cautious about how we looked at our investors. In the previous company that we ran, it used to be called Impulsoft, and Mr. N.S. Raghavan was the first investor, and it was a very profitable venture. We wanted to run Amagi in the same way. We valued every investor who came in, wanted to make sure that we give them the returns for which they came into Amagi. And therefore, we always looked at how to do the unit economics and how to build a cloud-based SaaS business, which never existed as a SaaS, and build the unit economics into it. That's where we focused on.
Amitava, with the experience of both FirstCry as well as XpressBees, what were the red lines, the non-negotiables that were drawn out? While I understand the appetite for wanting to chase growth, the appetite of wanting to take big, bold risks, of wanting to garner market share, what were the red lines that were non-negotiable?
Thanks, Shireen, for having me here. Logistics specifically, or even e-commerce, both are very scale-oriented businesses. You cannot build a large business, or you cannot have profitability without scale built in. But having said that, we were very, very careful on our gross margins, because we said, if we are burning at a gross margin level from day one, and that's what a lot of companies do, to build scale, the chances of turning profitable becomes very remote. So if you do it right, and if you make certain choices, even while remaining gross margin positive, you can turn profitable quite quickly. During Diwali, for example, e-commerce volume shoots, and logistics being a capacity game, you have to build capacity to handle the festive volume. Now, while you build the festive volume to handle capacity, you make conscious choices, because post Diwali, you have to ramp down quite fast. So there you make certain choices and not take all that is available to you, because you have to keep in mind that after the 30 days period, a ramp down has to be fast. Otherwise, if you just chase growth, it is going to come and hit you badly for the next couple of months. So a very, very practical and recent example. So you choose to what extent you want to build the flex, so that it doesn't hit your bottom line too hard for the next couple of months. So while you sacrifice on the top line, but you save on your bottom line. So this is just one example. You make such choices while building a logistics business. As I said, logistics is a scale business, but I think no logistics company of our scale probably had turned profitable in 7 years, and it's the result of conscious choices that we have made over the period of last few years. But it is also important to remember, in logistics, being very small is not the answer. So you have to balance between building scale and chasing profitability, which is very, very important.
Now QCI has launched a